it snapped. In one trading session, the benchmark silver futures price dropped about 31%, the kind of move that makes professionals double-check their screens because it looks like a bad print until the close confirms it. Not months, not weeks. In 48 hours, the metal went from a record-chasing sprint to a full-body collision with the limits of leverage. Markets are built on the assumption that depth and liquidity keep things orderly. A one-day collapse of that size is the market admitting, out loud, that order was never guaranteed. The most important detail isn't the percentage, it's what that percentage implies. It's usually a forced action. It means someone didn't just decide to sell, someone had to sell. It means the market wasn't a calm auction where buyers and sellers met politely at a fair price. It was a cascade where the rules of participation changed midstream and the weakest balance sheets were pushed out first. Here's the part that should stop you. While the public watched the price collapse, the institutions that live inside the plumbing were not surprised by the mechanism. They watch collateral, they watch margin, they watch volatility triggers, they watch inventory classifications and funding stress. They don't need to predict tomorrow's headline. They just need to know when the market is set up so that one push becomes an avalanche. And that sets up the pattern interrupt. This breakdown wasn't primarily about emotions, it was about math. Once that switch flips, the narrative comes later. The damage comes first. Welcome to channel name, where we decode what matters before it becomes a headline you've already missed. And if you want to add to the map, comment where you're watching from, because signals show up differently depending on which side of the world you're standing on. Now let's reconstruct what actually happened with the level of detail that turns a shocking chart into a readable sequence. In the days leading into January 30th, silver had been running hot. The story on the surface was simple. Metals were strong, inflation anxiety was alive, industrial demand was a tailwind, and the momentum trade had friends everywhere. The story underneath was more complicated. Volatility was rising, trend followers were adding exposure, options dealers were managing heavier books, leverage was building because leverage always builds when a market feels like it can only go one way. The timeline matters. The market didn't wake up and choose chaos. It moved from strain to break. Into the last week of January, swings widened and intraday reversals became sharper. That is, the market telling you liquidity is thinning. Then, as risk repriced across assets, silver's downside started pulling on the threads that hold leveraged positioning together. When those threads are stretched, even a modest shock can cause a disproportionate tear. Silver is not just a metal sitting in a vault, it's also a layered stack of financial claims. Futures contracts on COMEX represent 5,000 ounces per contract. Options sit on top of those futures. Swaps and structured products sit on top of the options. Exchange-traded vehicles sit on top of the idea that they offer silver exposure with one click. When the world says silver, it often means paper silver first, with physical silver somewhere in the background like a stage prop that is rarely touched. That distinction matters because paper moves fast. Paper can be sold in milliseconds. Paper can be sold under duress. Physical silver cannot teleport. It must be refined, assayed, moved, financed, insured, and delivered in specific forms. So when the paper layer is stressed, the benchmark price can swing violently, even if the real-world appetite for actual metal is not collapsing at the same speed. On January 30th, the market hit that stress point. The visible part was the plunge. The hidden part was the chain reaction. Price fell, which increased volatility. Rising volatility tightened risk models. Risk models tightened position limits. Tighter limits triggered margin calls. Margin calls forced liquidations. Liquidations pushed price down again. That second wave hit options hedging, which added more selling as dealers adjusted. Liquidity providers stepped back because nobody wants to be the bid when the next wave is unknowable and the spreads are widening under your feet. In a normal environment, a large move invites counterbuyers. In a margin squeeze, the counterbuyers may exist, but they wait because catching a falling market can be punished by the next collateral demand. The result is a vacuum. And vacuums don't look rational. They look like a breakdown because they are. As the dust rose, a central contradiction appeared. If silver was truly drowning in supply, if this was simply the market discovering reality, then physical market signals should have cooled instantly. Instead, reports out of Asia indicated the opposite. In China, Shanghai silver was described as trading at a record premium, more than $14 above London benchmarks in the same period. That is not a rounding error. That is a red flag. Add in elevated silver lease rates around 3%, the picture starts to look like tightness that refuses to match the crash. That is the crisis unveiled. Not just a crash, but a split. And when a split appears, history matters, because history tells you what tends to happen next. In 1980, silver became the symbol of a commodity frenzy. The details were dramatic, but the mechanism was plain. Leverage and speculation pushed the price higher, and then the system responded with tighter rules and higher collateral demands. The unwinds were savage. The result wasn't a gentle return to equilibrium. It was a collapse that taught a generation what a margin spiral looks like. In 2008, the lesson returned in a different outfit. When funding markets seize and risk is reduced everywhere, commodities that seemed safe can be sold simply because they are liquid. The result is not a judgment on the asset, it is a scramble for cash. Silver has lived through that scramble, and it remembers. In 2011, silver ran again. It was a different world, different players, different headlines, but the same internal structure. Volatility climbed, leverage followed, and then margin requirements were adjusted upward in rapid sequence. The price didn't simply drift lower, it fell in steps, each step reflecting forced selling, each step making the next one easier. Traders watched the margin calendar and understood the plot. In 2020, during the global liquidity shock, metals experienced another reminder that the first move in a crisis is often about raising cash, not expressing a long-term thesis. Silver sold off hard, then later behaved very differently once the forced liquidation wave passed. That two-phase pattern is important. Purge the leverage first, then let the underlying drivers speak. Now in 2026, the rhyme is hard to ignore. A strong multi-week run, a crowded long, a volatility surge, then a violent air pocket that looks impossible until you view it through the lens of collateral and liquidity. This is not superstition. It is the way leveraged markets behave when conditions change quickly. Here's why the historical pattern is so important. After a leverage-driven break, the market doesn't just reset and move on. The aftershocks show up in the relationships between instruments. Future spreads can distort, regional premiums can diverge, inventory reports can be misread, and the institutions that can survive volatility use the chaos to reposition while the public argues about what just happened. So let's talk about the players, because the players explain the timing. At the core is the exchange and clearing system. On COMEX and CME, the clearinghouse sets initial and maintenance margin levels. Margin is the admission ticket to hold a position. When volatility rises, the clearinghouse may raise the ticket price. If the ticket price rises faster than a participant can deliver cash, the participant exits. Exiting means selling. When many participants face the same higher ticket price, selling becomes synchronized. In January 2026 coverage, initial margin levels for the COMEX 5,000-ounce silver contract were discussed around single-digit percentages, with references like 9% as a benchmark figure in that period. Whether it is 9% or a nearby level, the exact number is less important than the direction and the speed of changes. When margin methodology shifts or requirements rise into a volatility spike, the effect is immediate. It is not a prediction. It is a constraint. Then there are the major liquidity intermediaries, bullion banks, prime brokers, and dealers that warehouse risk and hedge continuously. They are not bullish or bearish as personalities. They are risk managers. When volatility spikes, they cut. When funding costs rise, they cut. When client flow turns one way, they widen spreads and protect their balance sheets. Next are systematic funds and trend followers. These strategies don't argue with the market. They respond to it. When price breaks below key levels, their models reduce exposure. When volatility exceeds thresholds, they reduce exposure. That can turn a human story into a machine story very fast, because machines do not hesitate. Then there are hedge funds and macro funds that use silver as a trade expression, not a metal thesis. Some are long to express inflation, some are long to express industrial demand. Some are long because it is correlated with something else they're trading. In a stress event, correlations can flip, and those funds can be forced to de-risk across the whole book, which means selling silver even if their silver view hasn't changed. And then there's the public-facing wrapper, the massive exchange-traded products that hold physical metal or track silver exposure. One of the largest is the iShares Silver Trust. 20 ounces in trust and net assets around $43,480. Vehicles at that scale matter because flows into and out of them become real. Creations can pull metal into custody. Redemptions can release it. Either way, the hedging and liquidity around those flows can magnify volatility when everyone tries to move in the same direction at once. Industrial users matter too, because silver is not only an investment story, it is a material input. Manufacturers and refiners care about availability, delivery schedules, and financing. When the paper price collapses, some industrial buyers step back to reassess budgets, while others step in because the benchmark suddenly offers a lower reference point. That push and pull can add to the disconnect between the financial layer and the physical layer. Now, layer in the reporting infrastructure for physical inventory. The London Bullion Market Association publishes London Vault data. $4 billion, represented by about 927,254 bars. Those numbers look enormous. They also hide a crucial truth. Not all reported metal is available to satisfy new demand at the benchmark price. Availability is a concept, not a total. A bar can exist and still be unavailable because it is allocated to a specific owner. It can be unavailable because it is pledged as collateral. It can be unavailable because the owner is not selling. It can be unavailable because it is the wrong form for the delivery that is demanded. It can be unavailable because moving it takes time, money, and trust in the chain. Total inventory can rise while effective availability falls. That's not a paradox. It's a classification problem. Now we arrive at the dislocation, the heart of this story. On one side is the Western benchmark system, dominated by paper claims. Futures and options determine the price that headlines quote. That price is highly sensitive to leverage, margin, and liquidity. When a cascade begins, the benchmark can overshoot because the selling is not about value. It's about survival. When that question becomes difficult, premiums rise. A premium is a price signal that the benchmark alone is not clearing the physical market at that moment. In the period around this breakdown, the reported Shanghai premium of more than $14 over London benchmarks was a loud signal that physical demand in that region was not behaving as if silver had suddenly become unwanted. If anything, it was behaving as if the benchmark drop made silver more attractive, but availability still carried a cost. Elevated lease rates around 3% add to that story because leasing reflects the cost of borrowing metal. When borrowing costs rise, it can indicate stress in near-term availability even when the headline price is falling. So you have two messages. That is not sustainable forever, but it can persist long enough to create the conditions for the next move because markets do not correct contradictions instantly. They correct them through the path of least resistance, and the path of least resistance depends on collateral, logistics, and psychology. This is the part most people miss. A benchmark price is not a guarantee of physical availability. It is a reference point. When the reference point is driven by financial liquidation, it can temporarily detach from the cost of sourcing real metal in the real world. That detachment can show up as regional premiums, delivery delays, and odd behavior in spreads. It can also show up in the way people talk. Meanwhile, the quiet signal of a premium says something else entirely. A premium is the market's whisper. The quote is not the whole truth. Now let's put the evidence in a tight sequence because tension dissolves when facts are arranged. First, the magnitude. A roughly 31% one-day drop is the fingerprint of forced liquidation. It is too fast to be a slow reassessment. It is a clearance sale driven by constraint. Second, the leverage environment. Silver's contract structure and options activity allow large exposure with limited upfront cash. When volatility rises, that structure becomes fragile. The fragility is not an accusation. It is a design feature. Third, the margin and clearing dynamics. When margin requirements rise or methodology shifts, the short-term impact is to reduce open interest by pushing out participants who cannot post more collateral. That reduction is selling pressure. It also reduces liquidity, which makes selling pressure more damaging. Fourth, the inventory optics. London vault totals in the tens of thousands of tons can coexist with physical premiums if the readily mobilizable portion is smaller than the total suggests. Large totals do not automatically mean low premiums. They mean the system has metal, not that the system has metal for you, now at that price. Fifth, the geographic split. A reported premium of more than $14 in Shanghai relative to London is an extreme contrast. It is the market's way of saying the paper benchmark and the local physical reality are not aligned. This is not a conspiracy. It is a market structure doing what market structures do under stress. Paper clears first. Physical clears slower. When the bridge between them is stressed, basis and premiums become the language of the truth. Now let me show you how the mechanism executes in a way that makes the complexity simple without pretending it's simple. Think of leverage as a stack of blocks. Each block represents exposure. Margin is the hand holding the stack steady. In calm conditions, the hand can hold a tall stack. In volatile conditions, the hand shakes. The system responds by demanding a tighter grip, meaning more collateral. If the person holding the stack cannot tighten the grip, blocks fall. When blocks fall, they don't fall one at a time. The falling blocks knock others because positions are linked through hedges and correlations. On January 30th, the stack was tall. The hand shook. The grip requirement rose. Blocks fell. And because many participants were built the same way, the falling happened together. Margin calls are the blunt instrument here. If a participant receives a margin call, the participant has two choices: add collateral or reduce exposure. Adding collateral may be impossible in the moment. Reducing exposure is immediate. Reducing exposure means selling into a falling market. That selling pushes prices lower, which can increase margin requirements, which triggers more margin calls. It's a spiral. Options add another lever. When price falls quickly, option deltas change. Dealers hedge by selling futures, which adds to the downward pressure. If volatility rises at the same time, hedging becomes more aggressive. This is why some sell-offs feel like they have an engine. Liquidity is the final ingredient. When volatility spikes, market makers protect themselves by widening spreads and reducing size. That means there are fewer bids. Fewer bids mean each sell order moves the market more. This is how a market can move violently even without a single villain. It is a system effect. Now step back and ask what this means. In the only language that matters, what patterns like this have historically led to. After leverage is purged, markets often experience a tug-of-war. One side says the trend is broken and must mean revert lower. The other side says the liquidation was an overshoot and real demand will reassert. The truth tends to be revealed not by opinions, but by indicators. A conservative scenario is stabilization. Volatility cools. Margin changes slow. Open interest rebuilds gradually. Regional premiums compress back toward typical levels. The market trades a range while participants regain confidence. In that case, the warning has been heard and the structure heals. A moderate scenario is a rebound phase driven by the end of forced selling and persistent physical interest. In that case, premiums may remain elevated for a time, suggesting the benchmark drop did not fully clear physical demand. The key would be whether funding conditions ease and whether hedging flows stop reinforcing downside momentum. An aggressive scenario is renewed stress if the paper layer remains fragile while physical tightness persists. In that case, the dislocation can widen again, and the system may be forced to reconcile it through either higher benchmark pricing, lower physical premiums, or a combination that reshapes spreads. The tell would be persistent large premiums, rising lease rates, unusual shifts in inventory classifications, and continued volatility spikes around margin events. If you want a simple checklist of what to watch, it starts with volatility and open interest. When open interest collapses alongside price, that hints at liquidation. When open interest rebuilds while premiums stay firm, that hints at demand returning through the structure. Add in future spreads and the cost of carry, because stress often shows up there before it shows up in headlines. Notice the framing, it's conditional. If X continues, historically Y follows. Okay? That is the only honest way to talk about markets, because markets are not obligated to follow anyone's script. Now we come to the choice ahead, the divide that forms after moments like this. Some people will treat January 30 as a random accident, a freak day, a bad headline, then they'll move on until the next shock arrives. Others will treat it as a signal that the market structure is under stress, and they'll start paying attention to the plumbing. Not because they crave drama, but because the plumbing determines which moves are possible. It isn't about being early to a meme. It's about understanding why institutions move first and the public moves last. Institutions aren't mystical. They are simply closer to the mechanisms. They watch margin schedules, they watch funding markets, they watch flows through large vehicles, they watch regional premiums because premiums reveal stress. That information gap becomes the real divide. Because the first move is often the most consequential move, and it happens before the narrative feels safe. Silver's breakdown was a warning in numbers. It said leverage can make a strong trend brittle. It said liquidity can vanish faster than confidence. It said the benchmark price can detach from physical stress signals long enough to punish anyone who assumes the screen is the whole truth. And it said the next headline will likely arrive after the next repositioning has already happened. This is channel name, where we decode what matters before its headlines. If this helped connect dots between the crash on the screen and the strain underneath it, you know what to do in your own research. The question isn't whether markets keep testing weak structures. The question is whether the next test arrives before most people realize the last one was a final warning.